Hi, this is Professor Nugent, and I want to take some time today to go over the round one results. So here are the current round points for round one, and we have a top scoring team of 994 points, almost 995 points, and that percentile rank of 93% means that this team has done better than 93% of the teams who have played the simulation in the past 2 years, which I think is around 5,000 teams. So that's a spectacular performance. And I have 3 teams in the 90 percentile, and then it kind of goes down from there. Now remember, you're shooting for 2,500 points or more. So this team is, 2/5 of the way there already. So if you think about 2,500 points, you want to score an average of 500 points a round. Now, since the scoring of the overview is year over year, having a great year in year one makes it a little bit difficult to have this spectacular year in year two because you're trying to beat yourself, in essence, in your year over year points. I'll explain more of that later. Now, profit margins are key. So everybody started out in the first year of the simulation, you get data, and you start out at a 40 percentile profit margin. So the teams that were able to increase that to a higher percentage pleased investors, pleased shareholders, and the stock price went up, your profits went up, your points went up. If you have less than 40%, you've disappointed. It shows that you didn't do any research about where your profit margins were when you started taking over the company, and that you allow them to deteriorate below the 40%. So anytime a company has deteriorating profit margins, investors are not happy, analysts are not happy, and that's a problem. So it's something to focus on moving forward. You always want to have, a company is like a shark. They have to keep swimming forward and they have to keep progressing. So companies need to continually improve profit margins as well as sales. And so here we can see a range of stock price from $9 to $16. And total points are the same because we only have one round so far. And then operating profit margin is looking at your profits after your biggest operational cost, which would be marketing. So if you market too heavy, you may get more demand than you're capable of providing vehicles for. So you want to look at your individual performance chart, and at the bottom of your individual performance chart will be a market versus actual. And that will give you a good idea if you have produced too little and maybe marketed too heavily. All right. Your earnings per share, and we have a range from $2.23 to $5, and return on assets. Net profit margin, which is going to look at, you take away your taxes and interest, and you're left with your net profit margin. And okay, then we also have our sales per share. And we could see quite a range from $14 to $23. So we have a nice range here of sales per share. And what really changes the sales so much between companies? Well, one, if you don't produce enough cars, you may be not meeting your demand, and other competitors are picking up that demand from you. You may have not been marketing enough, spending enough in advertising, and limited your demand. Or you may have made vehicles that just weren't attractive enough and had a smaller demand, or a combination of these. All right, so let's go ahead and look at the charts. So I'm going to look at the industry charts. And I see here that this company here, when we look at total net profit, so this company, Abe, has the most profits, $52 million in net profits. And the company next to it has the lowest at $31 million. So this just shows you there's a big range in company performance based on how focused you are on profits. So remember, you sort of learned from your finance class, that the goal of any business is to maximize shareholders' wealth. So you do need to be profit focused on your profits. We can see we have a pretty big range of performance here in profits. If we look at points, we'll see that there is it's a similar pattern to the profits, but slightly different here. So Lorraine's cars and trucks had a stronger performance in points, and that just might mean that even though she didn't have the highest profits, she may have had the most efficient, well-managed company as far as the other aspects that analysts would look at. And the overview points are a collection of financial and operational ratios that analysts would look at in measuring your company. Okay, so here we have the stock price, and again we have that range of $9 to say $16 here in the stock price, all moving from a $5 range. So all teams were able to increase their stock price, which is good, and all teams were able to increase their sales. So no team really failed here. All teams were able to, increase their sales and increase maybe not the profit percentage, but the total profits. We have number one in sales here is, again, the Thriller Knight Motor Company. Now, why isn't Thriller Knight Motor Company number one in points as well as profits and sales? Well, being number one in sales doesn't mean you're number one in profits or the most liked company by analysts as measured by financial ratios. I could become the number one in sales in any industry that you want to challenge me into. I can become number one in sales. And what I could do is I could go in the auto industry and I could just price my cars very low, and I will gain the maximum market share and have the highest amount of sales dollars. Although I'll have zero profits because I'm probably selling the cars at a loss. Sort of what happened to Amazon.com and Buy.com. Buy.com tried to compete by selling products at a loss, figuring that they'll make up the difference in advertising. Well, they did have a very strong growth in sales. However, since they weren't generating any profits, they're basically wrapping a $5 bill of losses around every product they shipped out. They went out of business pretty quickly. So sales are important, but only if you have your profits in line as well. Okay, earnings per share, and we have a broad mix of earnings per share here. And you may see that the number one company in profits isn't the number one in earnings per share. And the reason for that is because of outstanding shares. So this company must have repurchased some outstanding shares to lower its amount of outstanding shares as well, and that helps to increase the earnings per share. So you don't have to be number one in total profits to be number one in earnings per share. And earnings per share is what dramatically helps the stock price. Okay, so it looks like we could see that this is the total market share by units sold, and we see we got most teams are in the 8,000. Have an 8,300 team that sold 8,300 vehicles, 8,800 vehicles. That's the biggest team, and however, if we look at we can actually get the percentage here. So most teams are around 5 or 4% of market share because it's a big market. Okay, but a small percentage, 25% increase in market share or a 0.5% increase in market share is a lot of cars and a lot of money. So we're dealing with a big cost item here. So let me go into the actual. I'm going to go into my demo and give you some ideas as we're running into round 2. Okay, so I'm in my demo game. And this is round 1, so I'm borrowing some additional funds, which is raising my interest rate. So if you borrow, the more you borrow in additional funds, the higher your interest rate goes, and the more stock you issue for additional funds, the lower your earnings per share go. So if I was to change this to 0, we'll see my earnings per share are $4.90. But then if I go ahead and borrow $5 million, you see my earnings per share are $4.45. So those are consequences. Anytime you're making decisions in business, there are consequences. So here's my pro forma sales, $256 million. And that's not written in stone. Pro forma is an estimate of next year. So if I don't sell everything I forecasted to sell, this won't come true. And additionally, the surplus of 1.3 million or almost 1.4 million won't come true either if I don't sell every vehicle that I have forecasted to sell. So let me complete the round and move into round 2 where everybody else is right now in your team competition. And this is why it's good to continue playing practice rounds. To if you have ideas or you want to test things out, better to test in the practice rounds than lose points in the real rounds. Okay, so I made 667 points, and this is my overview page. So in here, I can see that my sales went up. My debt ratios are, my quick ratio is without the inventory is not as good, so I lost points on that because you don't want this to go down. My debt ratio actually went down down a little bit, which is good, so I earned points for that. My profit margins at the gross operational net level went up, so I earned points for that. And that generally translates into higher total asset return, equity multiplier, return on equity and earnings per share, return on assets. So all those categories went up as well. I was able to increase my market capitalization, which just means my stock price went up. And if you look at the student user guide, they define all of these key financial ratios and the formulas for how they're calculated, if you're wondering. You should have also have gone over these in your financial accounting class and your corporate finance course. Okay, so here my book value went up, and my forecasting was good except for sedan and truck. I came in at 96% of what I had forecasted. So that was close, and I did improve over year one. And I did increase my operational investments, made 100 points there, but I had a deficit. So if I have a deficit, and I saw in my pro forma that I had a surplus, that must mean I have excess inventory. So if I go to production real quick, yeah, I have sedans and trucks that weren't sold. Since they weren't sold, I didn't generate the sales of profits I thought I would have for them, and I wound up with a loss, which means that I probably should pad my surplus more if I'm going to forecast aggressively. In assessments, you can go in here and I can get some hints. My stock price was only 3. I'd like to have 5 stars. And it says here, buy back stock early when the price is low to help improve earnings per share. And this will raise stock price. By increasing profit margins will help. Okay, so I get a lot of useful hints by looking at the self-assessment area. So you should go, before you ask me about your performance and why you didn't do well, check out your assessment center. And then in the charts, and I was saying it's very important to look at this performance chart here as an individual chart, and go to the very bottom, and here we'll see in the economy class 2,000 was what my sales were. My potential was 2,254, which means that 254 cars were thrown back in the market for other companies to get a chance to sell them. So I under forecasted and maybe over advertised in my economy, and this is an inefficient company when my sales are not close to my demand. Now here you could see that I had the same situation in luxury where I could have sold additional cars, but truck and sedan, I had plenty of sales to meet the demand. In fact, I had produced too many vehicles and had leftover inventory. So you want to hopefully get somewhere close to the top of this demand, but not go over it too much. And so that's a key thing. This is a key measure to look at for analyzing your previous year's sales forecast and getting an idea. By looking at your demand number, that's a better number to go off of trying to increase your sales for next round compared to this round. Okay. So let me go back. And then I have my industry reports, which shows me what every other car company has done, how they built their cars and their financial results. Sometimes I get emails from students saying, this isn't fair. Other students are seeing what my company did last year or my decisions. Well, this is real life, baby. You go to any dealership and you can see exactly how the cars are built. Go to any annual report for last year, get all the financial information of public companies and how they did and how they performed. So, and you can also look at analyst reports to get these points are really like an analyst score. So this is all data that you would see in the real world and that you should use to help improve your score. So you want to go back now. You say to yourself, well, I didn't get first place. Why? Well, go look at the company that did get first place, analyze what they did, and see if you can get any ideas of how to improve your performance. Financials are backed up here, and we start over again in sales. Now you'll notice that the customer expectations have increased, and the amount that you could sell, the top sell price of the car has increased. Now, customer expectations increase faster than your manufacturer's ability generally to supply them and make it ever increasing profit margin. That's why these operational cost reductions are important, because I invested in 3 levels of operational and cost reductions per vehicle, and I have a $900 cost reduction this round, which is going to help me to make stronger cars. So now I'm going to increase, remake my vehicles based on the new customer demands, and I'm going to reprice my vehicle, and I'm going to reforecast. And here right away I see that I'm coming at the 31 percentile, which means that that's much below where I had left off previously, so maybe I have to adjust some of my characteristics to get that percentage up higher. And that's sort of the game of research development is, how do I make a vehicle that's going to sell and still have a profit, a margin that will not upset investors. And this is something that you may find difficult moving into the next round. If you didn't invest significantly in operational cost reductions, it's difficult to keep up. And this is how, if you look at a Toyota in 1977, say the Toyota Corolla in 1977 to the Toyota Corolla today, a vastly different car, much bigger. The Toyota, I owned a Toyota in 1977, and it looked like a lawnmower engine inside of it. And today, you look at the engine, it's filled with computer components and safety features and luxury features and interior and cup holders and cruise controls and air conditioning and rear backup cameras. All these things are what customers expect these days. And if you don't invest in your operational efficiencies and in your production, you're not going to be able to meet the customer's expectations and maintain your profit margins. That's just a basic standard of companies. And sometimes companies have to lower their, like here, I'm lowering my engine power below customer expectations just so I can maintain my profit margin. Now, companies do this all the time. They do lower the quality of their products. They give you a smaller size. They don't advertise it. They may say new and improved. They give you less quality. Like when a lot of fruit juices decided not to use cane sugar but use the more cheaper and less healthy for you high fructose corn syrup. Or when British Petroleum decided to spend less money on safety features for their oil rig operations and caused a huge oil spill because they didn't have the highest, best quality safety valves and features at their own admission. Or automobile companies that make automobiles that they know will kill you but decide to let the production go anyway because the lawsuits are cheaper than the actual fix or the recall of the vehicles, because only 1 in 100,000 vehicles are going to be affected, so therefore they do the math and they find out that it's just cheaper to ignore it. So companies don't be naive, people. Companies are looking for every aspect to make their products less expensive, and hopefully you won't notice. If you, the quality of many things, garbage bags, tissue paper, napkins, just so many products have gone down in quality for what I remember when I was younger. The size and packages of cookies, of crackers, of cereal, everything, of peanut butter, of yogurt, everything's been reduced, but yet the average prices remain the same because companies have been giving you less or lower quality to maintain or improve their profit margins. But their marketing campaigns and their product design, you don't notice that you've got less peanut butter because they dimple the bottom of the peanut butter or they curve the outside of the containers in a way that it looks like the same size but really isn't. See, you have to wake up. Don't be blind consumers, because the companies are not going to advertise when they do this. They're going to spend a lot of money covering up the fact that the quality of your food is less than it was. I see a lot of this in the fast food industry. When I was younger, 16 through 17, I worked at a couple fast food restaurants. And you know what? The quality was not so bad. It was pretty decent. Today, when I go to those same restaurants, I see that the quality of food is completely terrible, and a lot of it has to do with that dollar menu competition and trying to compete so much on price that the quality of the ingredients and the amount of food that you get is just nothing compared to how they used to make fast food 20, 30 years ago. And it's really, sometimes it's easy to forget or not really remember because they change it so gradually, sometimes you just don't pick up on the fact. So don't be naive. No company is exceeding customer expectations when profits are low. If profits are low, they're going to have to give up on meeting or exceeding customers' expectations. And just because a customer expects it doesn't mean they're getting it. What your job is as a company is to maximize shareholders' wealth. So that may mean making a product that's not fully meeting the top end of customer expectations, but using marketing and advertising to convince them otherwise or make them not notice. For example, you can make a really low-end car like the Kia Soul, but just have really cute hamsters and Maroon 5 music in it and dancing hamsters and laser beams and robots. And you know what? People won't really care that the car is at a very low quality, and they'll buy it on the strength of the marketing. And there's no better car to prove that than the Kia Soul. Now, if you have a Kia Soul, I'm not insulting you. I mean, you know that you paid a lower price for it, so you can't expect it to be a Cadillac. But you may have first got your eyes noticed or thought about a Kia Soul based on its Super Bowl or its very effective marketing. And I think the Kia Soul has one of the most effective marketing campaigns from 18 to 34-year-olds. And many of those people don't take the time to really look at and compare their cars against other similar cars and other similar models. And that's true for a lot of car buyers. When they go to buy a car, they're not going to stack up every car every truck in the industry or every sedan in the industry and compare every facet of it till they find the best mix of features to price. You know, some people will do that, but not everybody. Most people won't. They'll go to a lot, they'll find a car that's nice, and they'll buy it. Okay, so I'm kind of entering this in fast because I've been talking too much. And again, I'm just kind of winging this a little bit, but I've done this plenty of times, so I know what I'm doing. Until my results come back poor, and then I say I don't know what I'm doing, obviously. So let me. Okay, so I put now, due to the shortness of the summer session, all the work that we have in this class, I'm not expecting you to fill out these reflective observations, but it would be a good idea to read them and think about them a little bit. It does help to reinforce what you're doing in the game, and it kind of points you to what you should be thinking about. Okay, so in the marketing page, the student user guide does a good job of describing where the effectiveness is in the different marketing areas. Now, remember, you're putting whole dollar amounts in here, not percentages. And if nobody invests in radio, and you're the one person who put $1 in there and no one else invests in it, you're going to pick up all the demand that could be in that radio spot. Because you're dominating radio, you're going to get all the demand that's associated with radio. So you don't really want to leave any of these blank. You want to have some money in all of these different media outlets, but certainly more money in the ones that are most effective, which I believe are usually television and newspapers. Okay, so I'm going to fill this out and then move on to production, but I'm not going to make you wait while I fill it out. I'm just going to pause it here and complete it and then move it forward. Okay, so now I'm here in production, and I see that I need to make 3,000 cars. My current capacity is only 2,000, so I'm going to buy a plant. Now remember, don't go and buy extra plants when you don't need them. Can you imagine I only need to make 3,000 cars, which means I need 3 plants. If I were to buy 3 additional plants and have 2 plants that aren't doing anything, just picture that whole big production plant with all the employees and the equipment sitting there for a whole year not doing anything. I'm still paying all the fixed costs and all the salaries. So you just have to understand that capacity, you want to match your capacity to what you're building. You don't want to have extra idle capacity. So here I'm doing that, so I'm going to need to buy a plant here. And figure most rounds you're going to need to have to buy at least 1 plant. And if I have leftover inventory, then I have to keep that into account, and I can repurpose and resell the inventory. Okay, so I want to make sure I have 0 excess or shortage here, because if I'm going to forecast something for all my financials to be right, I have to build the exact amount of production to meet that forecast. All right, so here in my operational investments, I want to increase my operational investments for 2 reasons. 1, I get extra points for year over year for increasing operational investments. And 2, it's going to make my next year's production of these cars even more efficient and lower costs, because I'm increasing my operations. I'm going to get a cost reduction as detailed down here. Down here, I get a cost reduction for each level I invest in. And you probably should have a better strategy than I do. I'm just kind of doing this quickly. There's no real strategy here other than keeping invested in here so I can keep ahead of the customer expectations. And again, these are important. They let you understand about capacity utilization, which is not buying more plants than you need, and your operational investments. So I'm going to submit that. And I'll see how I did on my finance page. And this is, I'm going through my practice round 2, to help those who didn't really do so well in round 1, or to maybe help sharpen or focus people who did do well and maybe give them some ideas of how they could do better. Okay, so I have a $16 million surplus. So I'm going to buy back some of that stock that I sold last round because to help my earnings per share. And I still have a $10 million or $11 million surplus, which I think you should always have between $11 and $20 million surplus, just in case you don't sell all the cars you forecasted, so you don't have an unexpected deficit. So I'm going to process this round and then see how I did. And that's why, if you're going to move from you're round 2 now, you may want to go to the practice and do similar to what I'm doing and try out some of these ideas. And here I had a deficit again of $6 million, so I must have had inventory I didn't sell. And I only had 373 points. Now, if I had that surplus, I would have had closer to 500 points because I would be plus 100. So that surplus is really important. That 200-point swing from negative 100 to 100 can really make a difference in getting a full points in this grade and not. So maybe closer to 20 million would have been smarter for me to have in a surplus just to make sure I wouldn't have those deficits, because apparently in my, I had 448 trucks and 190 economy vehicles that I didn't sell. Why didn't I sell those? Well, I definitely over forecasted. I may have under invested in marketing, or I just may have not had made the trucks and economy cars as attractive as they could have been. And I think I definitely lowered some customer expectations, and I shouldn't be forecasting above the top end of the expectations as noted in the student user guide. Okay. So in the overview, we could see that in most areas I did well. I was able to increase my profit margins slightly. Actually pretty decently. However, my assets increased greatly, which reduced my return on assets and equity multiplier because I invested heavily in assets, which is sometimes unavoidable. You can't perform perfectly in every category here every round because sacrifices have to be made. And sometimes acquiring a lot of assets now like plants and operational equipment, may hurt my return on asset now, but it's going to pay off later. So my forecasting was a little weaker, and if I didn't lose these points in the deficit, I would have done a pretty okay round because I'm trying to hit like 500 a round. Okay, so that is my recap of the results for the class on round 1 and my suggestions on how to proceed with round 2. I hope you find this video helpful, and I will see you soon. Take care.